Welcome to The Big Perspective, where we talk to some of the smartest minds in the Indian markets and pick their brains about the biggest trends shaping our financial landscape. I'm your host, Bhavya Dua. In today's episode, we are diving deep into the world of registered investment advisors, or RIAs, and how the rules around them have been changing over the years. Now, if you have ever looked for financial advice, whether it's figuring out where to invest your hard earned money or planning for your future, you know how tricky it can be to find someone you can really trust with your money. It's been over a decade since SEBI rolled out regulations for RIAs to ensure that investors get unbiased advice. But here's the thing, there are just about 900 RIAs in India. Of this, most RIAs are stock tipsters. And if you just count the number of RIAs who do holistic financial advisory, maybe there are a couple of hundreds. That's it. For context, we have 10 crore unique investors. So why is that number so low? What's stopping more people from becoming RIAs? And how will the proposed changes by SEBI affect the advisory ecosystem? To help us unpack these questions, I spoke to Vivek Rege, board member of the Association of Registered Investment Advisors, who himself is an advisor with decades of experience in financial advisory. Vivek was also a part of the 14-member working group responsible for SEBI's new consultation paper, which aims to ease the requirement for becoming an RIA. In this conversation, Vivek shares his insights on the challenges faced by RIAs under the current regulatory regime, the evolution of RI regulations over the past decade, the key highlights of the new SEBI consultation paper, the ongoing debate between RIAs and distributors, and the impact of incidental advice, the future of financial advisory in India, and what more needs to be done to promote the profession. Listen in as Vivek Rege provides his big perspective on the past, present, and future of RIAs in India.
Back in 2013, we were among the first 30 companies, if I'm not mistaken, to get a license from SEBI. Let me take you to something which is more factual. Somewhere around 2020 and 2022, there was a tectonic shift which happened. However, the supply was never from an IA. The supply started happening from an unregistered entity.
NISM exam being tougher than before. Do you think those were necessary?
As recent as March of 2022.
All right, I welcome you on the Big Perspective, Vivek. Thank you so much for taking out the time and talking to us about the big picture view of what's happening when we look at the investment advisors, what the SEBI consultation paper that came out recently says, how the regulations have evolved in the last one decade, and what the outlook or what the future ahead looks like, right? So before I actually begin and go into the technicals or in depth about the consultation paper and the regulations, let's start with you giving us a background about yourself. Why did you choose to become a registered investment advisor? What was the journey like? Is this you following a passion? Was this an accident? Could you tell us what this was?
Yeah, so thanks Bhavya, for giving me an opportunity to, share my perspective on the consultation paper and, the whole journey which I have witnessed. Before that, let me step back and take you back to 2003. This is, more than a decade back, more than 2 decades ago. So that time, the mutual fund industry was just privatizing in terms of, getting the ARN holders on board it. Okay, so it was getting regularized in that form back in 2003. I entered into this industry as a mutual fund distributor. Prior to that, I completed my CA Inter. I was working very briefly in the corporate and the audit space, the corporate law and the audit space. And one of the things which always interested me is to advise something which is in the future. Okay, because as you know, the audit and all the practices are pertaining to the past. And that was the starting point. That part of time, since the industry was regularizing, I thought I am in the best position to start as a mutual fund distributor, because that point of time, nobody knew what an advisory was really. So when I started in 2003, I started as a mutual fund distributor and an insurance agent for a company. Okay, this was uh, typically greenfield because I had no clients of my own. I just started off with the thought that let me start something on these lines. Uh, I completed post my CA. I completed my CFP in 2007 and then an MBA finance from NMI MS, then CFA level 1. So this was my educational background till date. While I was doing the mutual fund distribution, one of the things I realized is that advisor was, the advisory piece is always embedded in what was given to a client. And fortunately, I got in touch with clients who were typically at the senior management level. And I thought that, these people really require an advice. So far, though it was distribution, they did value advice. And therefore, the whole journey started with advisory, though it was not recognized as an advisory. But the clients did recognize that there is a difference between what you're speaking versus what somebody else is speaking. So, when he seems to be on my side of the table than on the other side of the table. Okay. Something which is win-win, not a win-lose. So, from that, my career took off. I started as a proprietorship. By 2008, we had reached the scale where we said, okay, let me convert it into a private limited company. So we converted in 2008 into a private limited company. And the things were moving ahead till a point of time when 2013, the regulations were being formed. Okay. And during this period, there was a lot of consultation which was done prior to 2013. If I am not mistaken, it was from 2011. And 2013, when the regulations came, it definitely made a sense for us to register ourselves with SEBI. Because if you go with what we have been doing, advisory was always embedded in what we did for our clients. And therefore, it was easy transition for us to move towards an advisory regulated space. And that's how I took applied for the RIA license back in 2013. We were among the first 30 companies, if I'm not mistaken, to get a license from SEBI back then. Again, that point of time, one of the things was, am I a long-term player or a short-term player? And if I'm a long-term player, it is good to start being regulated by a regulator. And it was very simple thought. We said, okay, let us go ahead. I think the two ingredients are met. One is advice, and the second is long-term. Right? And therefore we said, okay, instead of thinking too much, let us plunge into this ocean of regulations and being regulated. And that has been the journey up until 2024.
And do you enjoy being an investment advisor?
Absolutely, 100%. It is greatly satisfying journey also, because you differentiate yourself in the marketplace, number one. If clients are involved, they also understand the importance of being fiduciary in nature. And that gives you an edge always when you speak with them. Okay, you are removing conflict of interest. And people like to be on the same side of the table rather than on the other side. Okay. Also, I'm a very strong believer of disintermediation, whereby, the world is going through a disintermediation cycle, whereby most of the intermediation is going out. Okay. Or it is minimizing over a period of time. And therefore, I think being directly connected with the client and having a fiduciary role to play, nothing like it.
Also, when we talk about the current state of RIAs, let's dive deep into the regulations part here, since we're talking about how it feels like to be an RIA. Could you give us how the regulations have actually evolved from the past to the present when we talk about the RIA regulations specifically?
Yeah, sure. So it's very interesting. So what happened is when I entered in 2003, as a mutual fund distributor, uh, essentially the world was commission based. Okay, entry load commission based, which means you put in a product, there is an entry load which will be charged to the client, and from the entry load, a commission will be paid to you by the mutual part. The first stage came back in 2008, when the entry load was abolished. Okay, and that started the first very early days of advisory, whereby because the entry load was abolished, the revenue was disrupted at that point of time, because earlier it used to be entry load and you used to get commission immediately. But then the world moved towards the trail commission, which means that you have to be in alignment with the long-term holding of the client, and therefore, you should generally be getting compensation on trail, not on upfront. Okay? And that's where there was a sea change in the way the compensations also moved. Okay. And in those days, we started talking with the clients and explaining it to them that this change has happened, and therefore we would be charging you a fee. Okay. And the fee mechanism charging, to the client started back then in maybe around 2009. Okay. Very difficult conversation that point of time, because you are asking for a fee now. Okay, but one good thing which worked for us is that pre-2008, between 2003 and 2005, it was also an era of passback of commissions. And one of the things which we did very good was we never passed the commission back to the client and took business. Okay, so one of the philosophy was, if you want, you can compete on quality, not on price. And therefore we said, okay, if I have a choice, let me compete on the quality, not on price. And therefore, automatically the clients who became our clients never expected anything to be paid to them to give us a business. In 2008, when the entry load the entry load got abolished, and when we started speaking with the client, it was a natural progression for the client to say, hey, no problem. If you are going to be paid less, let me compensate you now. That's how the fee mechanism started. Okay. However, it was not regulated in that form and shape because there were no regulations that time.
Of course. That came about in 2013.
2013. And then in 2013 and a little prior to that, a lot of discussions were happening around that, can you charge a commission and a fee together? And therefore, an advice is being given, and the recognition for advisory and fiduciary, and the birth of the 2030 RIA regulations. Right. Okay, so that was primarily how things evolved. The first set of regulations coming out.
Okay. So, when from 2013, the regulations under SEBI for RIA came into being, since then to now, like since the time the space has been regularized by SEBI, to now we have just like 900 RIAs. And of this, a lot of the RIAs are also tipsters. And if you remove those and RIAs who also act like RAs, the number becomes even lesser. That means if you count the people who do holistic advisory or financial planning, we barely have about, let's say, 200 odd RIAs. Why is this? Why do you think that's happening? Why do you think the increase in the number of RIAs in the country are, since the regulation also has been at such a slower pace?
Okay, so there are a couple of reasons, but let me take you to something which is more factual, based, which is more number data based. Okay, so if we simply look at the Demat account number, the count of Demat accounts we have in the country, and I was, making a study of this. In 2013, approximately 2 crore Demat accounts were in were active. Okay. By FY 2020, which is 31st of March 2020, the demat accounts moved from 2 crores to 4 crores in the span of 7 years. Okay. FY 2021, just 1 year later, and if you know that was a COVID period, typically, the demat accounts moved from 4 crores to 6 crores.
Right.
And FY 22, the year later, it moved from 6 crores to straight away to 12 crores.
Right.
Okay. And 12 and 14 and 18 up to 31st March of 24. So if you look at the data point, somewhere around 2020 and 2022, there was a tectonic shift which happened. Okay. And this basically meant that a lot of investors came in. Okay. If you also look at the ALFI data on number of folios, it is typically giving the same trajectory, similar, very similar to what. So what also means is that not only demat accounts increasing, even mutual fund folios increased in that period. Okay, so I think investors were definitely looking for an investment advice. In 2013, when the regulations came, those were initial regulations which came. Okay, and then there were 3 consultation papers which happened in between, and there was discussion around how can this be regulated further, etc. But what happened after all of this is that in 2020 there was a change in the regulations which came through a circular. Okay, that circular changed the life of the IA completely. Okay, in many ways. Okay, and that created a sort of entry barrier. Because lot of elements were introduced in that. Okay, one was in terms of, so just to give you an example, the earlier regulations spoke about qualification or experience, which is 2013, Avatar. In 2020, it became qualification and experience. Okay, which means you are raising the bar now. You are saying you should have a qualification XYZ and you should need an experience, whatever, ABC. Now, both of those combinations applied not only to the principal officer who is starting a firm, but also to the persons registered with investment advisors, which is known as PAI. Which means the talent force also required to have the qualification as well as experience together. Third was the certification, which was already there, but the degree of that exam, the degree of difficulty of that exam was moved up in the period as well. Fourth thing was a client limit. Individual couldn't accept more than 150 clients. This all happened in September 2020. Then net worth was increased from 25 lakhs to 50 lakhs for a corporate. Okay, which means now if you have to move to a corporate, you have to put in more money as a net worth. The fee charging limit came in, which means the fixed fee of 1,25,000 or 2.5% of AUA, okay, came in. It was again a difficult, piece, because you have a fixed limit now of 1,25,000 per annum. You cannot charge more than that. There was a switching period limit which came, saying that the client cannot switch within 1 year from advisory to distribution and distribution to advisory. But apart from that, it was also about within the fixed and the AUA based fee, the client cannot move. There was a 12-month cooling period in that. And a lot of operational compliance is increased in that. This was one of the reasons why people who wanted to take license started shying away from it. The second reason was in terms of the regulatory arbitrage. Because it's a matter of convenience, finally. Okay, so regulatory arbitrage happens when there are 2 regulations. One is lighter and one is heavier regulation. And naturally, most of the market participants will want to move towards the lighter one, obviously. So they start interpreting the regulations their own way, which means what is incidental advice, what gets covered in an incidental advice. So what is convenient to you, you may try to interpret it that way. Okay. The compensation was definitely always a problem, because if you're getting a compensation from a mutual fund, is far better than asking a client to give you a fee. It's always difficult. So that is the second lighter part of it, where you can get your commissions and still do whatever you. And third is, I think the enforcement also was not to that extent, because people were giving advice in the garb of incidental advice, which still was under the RIA regulations. And that activity was going on till a point by being outside the regulation, but still doing or continuing the same activity. So what happened was, and I always talk about the supply curve and the demand curve. The demand curve is your client or an investor who is looking for an advice. And the supply curve is the qualified people who are there in the marketplace. Okay. So the supply curve was fractured because of the level of regulations which came in September 2020. And it shied away people from taking a license under RIA regulations. And they were doing these activities outside the RIA regulations, using the arbitrage benefits to a large extent. And what happened was the client or the investor was getting what they asked for. However, the supply was never from an IA. The supply started happening from an unregistered entity. Okay. And that created a sort of a regulatory arbitrage till a point of time when this was pointed out at various points of time, the regulator. Okay. And there was a need to also relook at the regulations, because from 2020, again, there were few learnings. Because if you understand, by 2020, the regulator was looking at a data point which was from 2 crores to about, let's say, about 4 crores of demat account. So the regulator never also, that point of time, envisaged that it could be 18 crores. This was future, right? When you came with the regulation, for them, that number was 4 crores. Okay. They never knew that this 4 crores could be 18 crores by 2024 of March. Right. So, but I think in between, even the market participants were voicing it in terms of what is happening in at a grassroots level. Okay. And this is the reason why, this is the primary reason why I personally feel is that the numbers never went up. The third and the very important, attribution factor was an association. Okay, in 2020, the association, mostly in 2013, there was no association of investment advisor. Okay, the first association of investment advisor was formed in 2019, which is the ARIA, which is the Association of Registered Investment Advisors. By 2020, this association was not so well known. So even the regulator was trying to understand, okay, because an association always helps to bring the facts on the table very quickly. Okay, because it was very distributed and they had their own way of looking at it. The regulations of 2020 came in that form and shape. And now with the association in place and the regular conversation with the regulator, it helped us to convey the point to the regulator. And the regulator was also listening to us very intently that, there is a change required. And therefore, the change also cannot be something which is a patchwork. It needs to be an overhaul of the regulation, because patchwork will create another set of issues. And therefore, I think this consultation paper is a function of that overhaul of the regulation, which was expected to be done. It took a little time because a lot of consultations happened, within SEBI and the association and the working committee, etc. But I think it was worth it. it was worth it because the regulator could appreciate the viewpoint much better.
Okay. I have a couple of follow-ups from what we discussed right now. Like we talked about the increase in the number of DMATs from 2013 to 2024, from 2 crores to 18 crores, right? And the huge shifts that we saw from 2020 to 2021, then 22, then 24, right? So why do you think this rapid increase happened from 2020, from the pandemic onwards?
So see, typically what happened is that post-pandemic, I think markets have not gone through a down cycle. Okay. And if markets don't go through a down cycle, due to the quantitative easing and, a lot of factors which are linked to that, investors really have not seen the pain of being in the down cycle. Okay, these are investors who may not have been investors previously. See, the 2 crore investors or the 2 crore demat accounts pre-2013 at least had some clue about the up cycles and the down.
Some of them would have seen the 2020 down cycle, 2000 down cycle, then the 2008 down cycle, correct?
That's right. But by 2020, everybody forgot that. Okay, they saw, but this was the most brief down cycle we saw in COVID. That's the shortest of all in the history.
The comeback was really quick, which wasn't expected initially.
Extremely quick, because large amount of money came. But also what happened is that sort of created a confidence in the investors because they never saw the down cycle. Okay, and therefore naturally it's not their fault. I'm saying that it is very much possible for anybody to get swayed with these numbers and be gung-ho about it. And therefore automatically this fueled more expectations, and therefore the popularizing factor moved so quickly that no one really expected these kind of numbers to come in. But that was a pent-up demand must have been there. Probably it has just been translated into numbers today.
That was the follow-up from the demand cycle when we talk about the demand curve and the supply curve that you mentioned. The three questions that I had here, one that included this demand cycle. Second one includes actually both the demand cycle and the supply curve, the demand curve and the supply curve. We saw this increase during the pandemic. A lot of people, when I say a lot of people, I mean layman, because I spoke to a lot of people while doing this one series some 3 years back, which was finance for first-time earners. Right, so I was talking to people who were in the age bracket of 22 to 26, 27 years old, right? And a lot of them also attributed their increase in investment or their increase of interest in investing or in the markets in general because of what they saw on social media. A lot of things changed during that time. A lot of influencers came about, and again, a lot of regulations for them also we saw in the last entire year coming in, right? So do you think the increase in the term of in the amount of financial literacy that people were getting from these influencers, do you think that also served in the increase that we saw because people were watching this on their Instagram reels, on their YouTube shorts, random investment advices being given? Some of them came from credible sources, a lot of them came from non-credible sources. But the information was really quick for the people to go and watch at, whether it was in tier 1 cities, tier 2, tier 3, for millennials, for Gen Zs. Do you think that served as one of the triggers for the increase?
Absolutely, it was definitely a very big catalyst in what you see today. These were correctly influenced and these were not correctly influenced as many. Okay, going to a point where you might end up giving an investment advice without being registered. Okay, or one too many. Okay, therefore it was primarily an RIA activity, research analyst activity, because it's a too many. Okay, and people did consume this. So one is that people were not able to, the demand curve side of the curve were very ignorant. They were not aware about whether registered, not registered, and all that, right? So they consume whatever came to them. Yeah. And, on the regulation front, I think a lot of these influencers ended up flouting the regulations as well. And therefore, there was a concern in the regulatory space also in terms of how to. And I'm sure this also happened globally, but the amount of activity which happened in India was unprecedented. Unprecedented. Yeah. So definitely this was one, there is no doubt about it that, it has been a catalyst in, taking this to these kind of levels.
Mm-hmm. Talking about this, the one-to-many advice, which was unregulated, do you think the regulations that came in the 2020 circular for RIAs with qualification and experience both being a necessity, with NISM exam being tougher than before, do you think those were necessary?
See, actually, they were not necessary in that sense, because what happens is that if you end up making this too tight, then people may not want to explore this option. Okay, I think it is very important to see this industry from 50,000 feet and say that, okay, how evolved is an investor and how evolved is the participant, is the market participant. Yeah. And I think in early days, it is very important for things to set a very strong foundation. Okay, and regulations we catch up over a period of time. Okay, but the change which happened in 2020, okay, definitely the unintended effect of it was that the numbers never increased. Number never increased at that gap, because if you know the time when the influencers came is exactly a time after 2021. So the difference of 6 crore between 2021, March of 2021 and March of 2022, were 6 crore new demat accounts opened. And they were opened because of some influencing. And people wanted an advice, but there were no sufficient advisors in the market at that point of time. Okay, and that actually created a huge demand and no supply. Somebody had to fill up the gap. And the influencer filled up the gap in that. Okay, or whether they had a conflict of interest, how they made money was a separate matter. But there was a gap which was filled quickly by the influencers. Yeah, and this was not something which was envisaged by anyone. Okay, and this was something completely new. I think the way certain platforms came like Instagram, Twitter, took much more. I think case in that. So I think from that angle, definitely there was a kind of a tectonic shift. No one anticipated.
Of course, yeah. So you've mentioned twice right now that the numbers never actually increased. What do you mean by that?
So people have to adopt, right? They have to apply for an RIA license. Okay, and while they are applying, they are contemplating.
So you basically mean the number of RIAs never increased.
RIAs never increased.
Yeah. So when the number of people who were investing increased, the number of RIAs during that period never increased. Correct. If we talk about the current set of regulations, they were finalized after 4 consultation papers, right? So in that entire process, what do you think could have been done better? Like, I know we're talking about the past, but still, if I had to ask you what, according to you, could have been done better, what would that be?
I think it is very important to, hear the grassroots level on what is happening. So I think involving industry is very important. Okay, and I think one part of that was when no association was there, and I'm saying that if the association was there, that point of time, okay, it would have been really beneficial for us to talk with the regulator, and it would have been beneficial for the regulator also to know much more clearer views about the market. Right? Because people came at individual level and they spoke in the regulator, right? Including us. But we were all individuals. Individuals meaning in individual capacity. However, when an association speaks, it is a much more well-formed view about something which is going on in the marketplace. And you can go to the regulator with much responsibility in that sense. Okay. But I still feel is that it's very important even today for the regulator to hear the industry. Because the industry is always ahead in terms of understanding what is today going on, what is the client asking, how is the taste and the preference of an investor changing, okay, what is really going on in their life and how we can deliver them what they need. And therefore, understanding the realities or the current realities is extremely important. Very important at this stage. The views cannot be discounted at this stage because somewhere, down the line, maybe in 2028 or 2030, one may again have to relook at the way the regulations are. Okay, so forward view needs to be taken. More from a market development point of view, you need participants who are regulated, who understand regulation and whose posture and code of conduct is good, right? They don't shy away from the regulation. You need exactly those people in the marketplace to serve the investor set or the growing investor set whose tastes and preferences are changing. Okay, we have now the millennials who are entering the market. Their taste and preference is very different from their parents. Okay, and so on. Very different from their grandparents.
Yeah, I can vouch for that.
Okay, and I think it is very important because when I speak with you as a client, I learn a lot from you in terms of your preferences, taste, and I have to make sure that whether, we are able to serve you better. Yeah, ultimately, right? We cannot say that, oh, hey, we are there for the last 2 decades. This is how things are done. And that you may question completely and say, this is not something which I need. This is how I need. Okay, we might end up giving the advice having the same first principles. However, the way it is given to you or delivered to you will definitely undergo a change.
Yeah, because if we look at these different generations, because I also belong to that millennial Gen Z generation, right? So the things that were wants for the generation of my parents and grandparents have sort of become needs for our generation, which is a huge shift. So that changes the goal of financial planning, that changes the goal I'm saving for versus what they save for.
Absolutely. Absolutely. Because I think millennials will have the benefit of having a legacy of a very strong backup for them. And therefore, they can venture into something which is experiential. Okay. And therefore, the definition of investing, the way they invest will undergo a change. And I think we understand now, or maybe we are trying to understand and we are trying to communicate this to the regulator, right? That this is undergoing a change. Let's look at this. And at this point of time, it is very essential, very, very important to look at the next 1 decade, at least, to make sure that the regulations don't need to undergo frequent changes.
When we also talk about these regulations, you touched upon arbitrage in the regulations when some sort of less stricter regulations are there and people try to go and follow those ones because of obvious reasons, right? We also talked about incidental advice before. So I want to go a little deeper into these topics right now because there's this weird and fuzzy regulations that kind of allow distributors to do incidental advice. Now, some people argue that if you are a mutual fund distributor, you can do things that an RIA does, like goal planning, without the burden of the RIA regulations. Do you think this arbitrage of sorts between RIAs and distributors is another reason for the lack of RIAs in the market currently?
Yes, very much. And that's what I even mentioned prior, is that there is a misinterpretation of the regulation. The regulation is very clear. Regulation is very clear. Let me point out the way the regulation has worded it. For mutual fund distributors, the wording is about appropriateness. appropriateness of a mutual fund product to the client, whether the product is appropriate or not. That is the limited job of a distributor. Okay. When it comes to an RIA, the word changes from appropriateness to suitability. Suitability is far wider than appropriate, which means that I have to do your risk profile. I have to understand your life phase and your life stage. I have to look at from all the angles and then see whether this product is suitable for you or not. And it doesn't necessarily involve mutual funds. Correct? Therefore, the role of an RIA is far much more wider in that sense. And it is not linked to a mutual fund. And mutual fund distributor can only advise on mutual fund only at the moment. Okay, there is nothing like goal planning for them. Okay, because even in the mutual fund regulations, it has been clearly specified that an incidental advice is limited to appropriateness of the mutual fund product. It is for the product. And therefore, there is, so when you come to suitability, it has to do with goal planning. Okay. And therefore, financial planning has been defined in the I regulations. Okay. So the regulations are very clear. Unfortunately, they are misinterpreted. Okay. And the misinterpretation is for the convenience part of it. Okay. Because it is convenient, it is misinterpreted. And because there is no regulatory oversight on this activity going on. Okay. Last 5-6 years, this has been going on in spite of financial planning as having been defined very clearly in the I regulation of 2014. Right. Incidental advice of a mutual fund means that when you are advising, you might end up satisfying maybe one or two goals of the client. It is not the other way around. It is incidental. Okay, which means because you are giving a product, because I'm giving you a product, by virtue of that, incidentally, you might complete your retirement goal. It's very different from I saying, okay, I'm going to advise you on your retirement goal. I'm going to take all the data, number crunch it and give it to you. Give a report to you and then say these are the products which are suitable. That is not the job of the mutual fund distributor. So the regulations are very much clear. I think what is required is in terms of more enforcement, more communication from the regulator to the industry, saying that this is an activity which is comes under the I regulations, and therefore it is important to apply and do an activity which is a regulated activity under the SEBI IA guidelines.
So, Vivek, we have majorly talked about what all has been included in this consultation paper that came earlier this month. And we've also discussed your view on it. What are some of the good points and what are the things that could have been done better? But if we also talk about the fixed fee regulation that has been changed, could you shed some light on that?
Yeah, so I think since the September 2020 circular came, the fixed fee limit came as 1,25,000 per annum. Okay. Since we are now relooking at the limits, it will be good to revise the limits to about 2,50,000 per annum. Okay. Essentially, from an inflationary standpoint, even if you take a 7% inflation year on year, okay, it is good to have a 2,50,000 limit because up to 2030, if I'm not mistaken, you will not need to change the fee limit again and again because 1,25,000 is way too low. Certain nature of activities, what you do. Those are fixed fee activities. Yeah, so I think this is something which I would like to see if that can be revised to 2,50,000 per client per annum.
Okay, got it. And apart from this, when we also look at the supply side, the supply curve again, the regulations that have been there for the principal officer as well as the compliance officer, what are your views for the same?
So one of the good things what I see in this consultation paper is the way the principal officer, has been defined. So earlier it used to be, so I'm talking about a non-individual IA. So principal officer necessarily had to be a person who is a designated director, managing partner, executive chairperson, equivalent management body as a principal officer. But what they have done is that if you have an entity which is into multiple lines of businesses, then the principal officer need not be from what I just said. Okay? It can be, so basically it may not be a person who is a managing director, a designated director, a managing partner, executive chairperson, which is a good thing because it allows other people to, involve themselves as a principal officer, okay, instead of the founder only being involved as a principal officer. Okay, which is a good part of it. However, in case of a monoline business, they still insist. The consultation people still insist that the principal officer need to be an MD or a designated director, managing partner, so on and so forth. Maybe there also, if the consultation paper can maybe a little liberal with that, because finally it is about the right people sitting on the right seat. The principal officer is the responsible person who has to sit on the right seat with the right qualification, experience, certification. So you can bring a good set of people on board who take responsibilities of certain entities. On the compliance officer, I think one of the very important things which the regulation has taken care of is in terms of outsourcing. Okay, earlier the compliance officer had to be an in-house compliance officer. However, this time the paper talks about an outsourcing function can be given to a certain set of professionals, which are basically called as independent professionals. They have to be CA, CS, CMA as a compliance officer as their qualification. Plus, they also need to pass a certain exam, which hopefully, NISM will come out with. Okay, so that exam essentially will cover a lot of compliance aspects of how the compliance needs to be done in terms of an IA or an RA. But I think it's a welcome move. It's a welcome move, which basically allows an entity to outsource this to a CA, CS or a CMA who is an independent professional. However, the responsibility lies with the principal officer. Final responsibility lies with the principal officer, but it's a welcome move. It's a really welcome move.
Got it, understood. So apart from this, any other points that you would like to touch upon from the changes in the consultation paper?
No, I think I've pretty much covered, things which I would like to see in the regulations. And I also, articulated which of the part of the consultation paper are really empowering in that sense. Yeah, and I'm sure that this will change the trajectory of this industry as long as the quality is maintained.
So again, talking about this enforcement, we if we look at the enforcement on RIAs only, because there's this one theory that SEBI was sick and tired of RIAs acting as tipsters, which can be seen from the fact that there were numerous enforcements order against RIAs. So it made becoming an RIA a little tricky, right? So what's your take on this? Because we're talking about the enforcements on mutual fund distributors, so that there's a clear distinction between what the regulations are, and that does not really decrease the number of RIAs in the market. But what about the enforcement on RIAs that's been there for the past few years?
I will share with you an analysis which, ARIA did, and this is as recent as March of 24. Okay, so just to give you a number, there were 151 enforcement orders which were passed. Out of 151, 107 were of unregistered investment advisors, and 44 were of the registered investment advisors. Okay, out of this number, out of the 107 unregistered, 104 were tipsters, which is 97% of those were giving tips. Okay. And in terms of the registered entities, which were 44, 34 were tipsters, which is roughly about 77%. Okay. On what products did they give you a tip on? They gave you a tip on derivatives, which is FNO, buy today, sell tomorrow, intraday, right? Which is nothing to do with delivery based. Yeah. Or maybe something where you are doing buy today, sell tomorrow types, which is like ultra short term. Okay. Now these were the enforcement orders passed in terms of the entities having these kind of activities. You will not find any of these enforcement orders which had typically financial planning being done, or incorrectly being done, or an estate planning advice which is incorrectly given, or a tax planning advice which is incorrectly given, or an advice on international securities being incorrectly given. You will not find a single order on that. Okay? Because clients never complained. Correct? An order will be passed after client will complain to SEBI. SEBI will go through a set of advices which has been given to the client.
What about the rest 23% of the registered RIAs?
So those were in terms of maybe the fees which are being charged. Sometimes there are issues in terms of fees, or sometimes the issues could be in terms of the profit which the client expects to be given. Okay. So the orders, the rest of the 23% were the non-stock, essentially the non-stock, meaning the intraday, types of orders. Okay. But not a single order was in terms of the planning. Yes.
Got it. Also, there's a bit of a gray zone, so to speak, between RAs and RIAs. When we also touched upon this a little before when we spoke about one-to-one and one-to-many. Some RIAs become RIAs because they assume they can do advisory on futures and options, what we spoke about, right? Mostly in the form of tips. Do you think RIAs should be allowed to tip, or is there a merit to carving out a new set of regulations? The closest analog that we can draw here would be the regulations that were created for online bond platforms. So, do you think something of that sort could be done for RIAs?
It is very, very important and very essential, because these are the set of people have been in the IA space. Okay. And I think most of the enforcement orders, have gone, against them. And therefore, I think it is very important for this section to be carved out. Okay. Because the clients who come for these kind of activities are clients who have a different set of expectations. They have nothing to do with long term. They have nothing to do with goals. They have, nothing to do with purpose. Okay. So therefore, I think the nature of the activity, itself is really not an investment advisory activity in that sense. Okay, because these are which basically fuels more speculation, very, very speculative nature of activity. Somewhere I think the regulation needs to carve them out separately, and they be regulated either under the same regulation if they are carved out separately and differently regulated. And if even possible, and to that extent, maybe even make another separate set of regulations for people who are giving tips and who are doing intradays and something who are not really long-term in nature. Right? Who don't instill that basic ingredients of an advisory, more from an investment point of view, so that an investor doesn't destruct capital, he creates capital. Whereas if you see the SEBI communication and the analysis which they did, 90% of these people have lost money. Yeah. Which means, are you in the process of creating capital or destructing capital? That's a very important question to ask. An investment advisor in real definition should always be a capital creator, not a capital destructor.
Yeah, absolutely. Also, we talked about the regulations that came in 2020 quite in detail a while back. So if I have to touch upon that again while talking about how is it being an RIA with the current set of regulations? Because from that time onwards, the advisors have been really vocal about the requirements that are there under these regulations for an RIA, from educational qualifications to corporatization to fees to the experience, which we talked about. These are way too stringent. Again, we touched upon that earlier in our discussion. So, what are the challenges of being an RIA under the current set of regulations? Because you would have an experience yourself, and also being a board member of the association, you would hear it from others as well. So, could you share that with us?
Yeah, so a couple of points which are very important to understand the entry barriers for people to enter, as well as people to function who have already entered. Okay, so definitely one is the regulation part of it. The regulation required a postgraduate, okay, from specified fields. Okay, from day one, from day one. Okay, and experience of minimum 5 years from day one. Okay, the experience has also been defined under the regulation. Is what kind of experience will be taken into account. Okay, for a PAI who is working with you, who are basically assistant advisors to you, they need also a post graduation and a 2 years of experience. Okay. Now, if you look at this, and let's look at it from a people point of view. Okay. Do you get qualified people with experience in the marketplace today? Okay. Very difficult to get both of these ingredients together. They may have experience, but a different experience. So the combinations could be different. They may have experience, but different qualification, or they may have the required qualification, but a different experience. You will sometimes not get both together. Very, very rare. Which means you will have to groom people over a period of time, and then they qualify to work as an investment advisor with you or in your firm. Okay, so that was more from a talent pool point of view. It also means that more and more investment advisors won't be able to enter, because from day one you need a qualification and then experience, which is becoming very difficult. The third is the certification, the level at which the exam is today. And there are 2 exams, by the way. This is the only license where you have to give 2 exams, which is 10A and 10B. Whereas all other licenses, there is only 1 exam. And believe me, this 10A, 10B is very tough. Okay. And so therefore what happens is that the certification also becomes a kind of a hindrance. And not because you have to give it for the first time, you have to give it every 3 years. And if you don't clear those exams, then you cannot function as an IA or a PAI. Which means till you clear an exam, you are out of at least that much of work you cannot do under the regulations. So that was quite a regulation which was livelihood threatening. Because what will a person do? If he cannot clear maybe for 2 months, he cannot work in the firm. He have to give him the salary for whatever time till he or she clears that. So then the fourth factor was the client limit. Now individuals who are doing great work will be referred. They will get more clients. They will cross the client limit of 150. Now what happens at that point of time? They have to stop their work. They now cannot take the 151st client. They have to go and apply for a corporate license, which takes anywhere between 3 months, because by the time you apply with ROC till you get an IA license, it takes roughly about 3 months. Then you start writing to the clients, and then you start taking, right? And I'm saying minimum 3 months. There are times when it has also taken more time. Which means if a firm is doing a good job and the clients are referring to you, now you cannot take a client because you are an individual. So there is not a client cap. The fifth is a net worth. Meaning now, if we are crossing 150, you have to put a corporate private limited in place or an LLP in place. Now from 25 lakhs of net worth, that net worth has been increased to 50 lakhs. However, this is an activity which is not a capital intensive activity in that sense. Not as much as capital you require. This is a very knowledge driven activity. And therefore, requiring a capital requirement of 50 lakhs created another set of problems because the person has to create the capital, he has to put it in the firm, open the firm, put it in the firm and the net worth, then apply with SEBI. The sixth is the fee charging limit. 1,25,000 or 2.5% of AUA. You can either have one of it with the client, and the client cannot flip between the two. There was a 12-month window of period. And it became extremely difficult because some clients want to pay fixed in the beginning, and after 4 months, they say, okay, now I want to pay on the AUA basis because now I want to expose my assets for advice to you. Very difficult because you just can't do it now because there was a 12-month period. Okay. And then all the operational compliances which came up, along with that in terms of the audit. For example, segregation certificate. Segregation certificate can only be given by your statutory auditor. Okay, because they know the accounts, books of accounts, and they only will know whether the same client has received a commission and fees and all together, right? A compliance auditor will not be able to go into the books of accounts and do it. So there were a lot of these compliance issues which actually also created problem because the chartered accountants and the company secretaries also were not able to interpret the regulations so correctly. And it was difficult for them because the Institute of Chartered Accountants of India or the Company Secretary of India did not release anything in terms of the I regulations of how to audit. And that created another set of problems because now we have to educate them on how to audit. Okay. And then they will have their own set of, arguments, etc. till a point where they understand, okay, now I understand what the regulation is. So it took a lot of, it was a very friction, during this period because you need an audit certificate. Auditor is not able to interpret. You have to explain the auditor. And not all CAs and CS are able to appreciate what you do exactly, and then interpret and then give you a certificate of segregation. That a lot of these compliance issues actually also created a burden. So this was the September of 2020 circular which came into force and which tightened, I think, to a great extent.
Got it. So when we talk about the current consultation paper that came earlier this month, could you give me an overview of that? What were the things in that consultation paper that were good and what were the things that could have been done better? We can start with what were the good points of the consultation paper.
So, I would like to congratulate SEBI for taking this step to come out with a consultation paper. And it has been quite liberal in that sense, if you ask me. As in the undertone is quite liberal in that sense. So now they have, so let's take the qualification piece, right? The qualification piece has now been relaxed from a postgraduate to a graduate. Okay. For a principal officer as well as for a PAI. That your assistant advisor, for instance. Which is a great thing. The second is in terms of experience. Okay, the 5 years experience of the principal officer and the 2 years experience of a PAI has been changed to no experience. Right? So the entry barrier has come down quite a bit. And the certification, remains. Because I think what the regulator has tried to solve is that let the certification be the gatekeeper Okay, if you are able to pass the certification exam, then pretty much your job, qualification, and experience may not necessarily solve that problem. It is a good thing in a way. I think there are some issues here, but anyway, at the broad level, the undertone is very good. The client limit has been changed from 150 clients to 300 clients or 3 crores, whichever is earlier. Okay, which is also very good because now an entity which is not earning up to 3 crores but may have to go beyond 150 clients will now be able to increase and intake more clients. At least another 150 clients batch they can take. Okay. Or if the entity has crossed 3 crores, which means the entity has now scaled up. Okay. Even if it has 50 clients, let's assume. And therefore, it requires to corporatize. So the corporatization, the criteria has been changed from 150 clients to 300 clients or rupees 3 crores, whichever is earlier.
Yeah. And these were the good things according to you.
Yeah. So there are many good things. So let me complete. So the fifth is the net worth. Okay. So the net worth has been completely removed. Okay, and they have come out.
Wait, just 1 second for my own clarification. The first one being the post-grad requirement has been removed. The second one being experience has been removed. The third one being the number of clients changed. The fourth one?
The fourth one is net worth.
Yes, please go ahead.
So the net worth is now completely removed, and they have come out with a very nominal deposit to be, kept in lien. Okay, and which will be basically marked as a lien. Okay, and that is very, very nominal. So they have limits that up to 150 clients, you need about 1 lakh of rupees as a deposit. From 150 clients to 300, you need about 2 lakhs. 300 to 1,000 clients, 5 lakhs, and 1,000 clients at about 10 lakhs, which is way, way lower than what the earlier regulations. And I'm sure because I think the capital intensive nature is not there, and I think the regulator has understood it. But at the same time, keeping these deposits are important because if there are any disputes which happen, the resolution amount will be paid out from these deposits. Okay. The switching period has been removed, which means that a client can have a fixed fee and an AUA fee, and the time limit between the two may not be 12 months. Okay, which means that if you sign, let's say you sign a fixed fee letter with me, okay, we don't have to wait for 12 months now. You can say, okay, can I sign a AUA-based fee from next month? Yes, you can. And then can you go back to the fixed fee? Yes, you can. Which was earlier not possible because it was a 12-month cooling period. So if you sign a fixed fee with us, for another 12 months, you are fixed into that. After 12 months, you can change to AUA. Then another 12 months, you have to stick to that. And then again, you want to change if you want. Okay, now in between, because of this, many times even the clients have moved out, saying that this is quite inflexible, it doesn't work for us, etc., etc. So I think this was one of the asks what was done from the industry point of view also. So I think these are the good, side of the regulations or the consultation paper. If I may use the word consultation paper, right? They're not in the regulations. I think some areas of concern are typically in terms of the scope of activity. The scope of activity curtails an investment advisor and prohibits an investment advisor from advising on estate planning, on tax advisory, on international securities. It will also include ESOPs, which are internationally given to clients. Now that becomes typically a question mark because the client will come with all these asks, more from a financial planning and a holistic standpoint. Though the regulator is allowed advising on asset classes at a broad level. Okay, it has typically spelled out that services or ancillary services like estate planning, tax advisory, okay, and even securities which are not regulated within the country, okay, will not be covered under the ARIA regulation, which means the investment advisor will not be allowed to advise on this. In case of individual, we just cannot do it. But in case of a non-individual, also you can do it, provided you have another entity, which is a separate legal entity. It is not even a division. Separately identified division is also not allowed. It is a separate legal entity with a separate brand name. Okay, which is maybe curtailing the activity of the IA. I'm again saying that the demand side asks for it. The supply side today is now ready to give it. Now only some part of that they have to say that this is not under the regulations, so you will have to do it with some other entity of ours. Or we don't have another entity because I am an individual and therefore I cannot do anything further than this. Which means it opens a gap for now again to the client saying that I had come hoping that I will get everything under one roof. But now you are asking me to either go away from you, or you are asking me to go into another entity and sign a separate set of contracts, etc. Alright. So you are increasing the investor burden now by doing all that. Market participant burden will definitely increase, because if you have to start another entity, it has its own challenges also. Yeah, so the ease of doing the work is maybe a question mark as far as this particular scope is concerned. A couple of things which also I think are concerning is in terms of the audit report, the number of months in which the audit report has to be given. Earlier it used to be 6 months, now it is 2 months. And we are wondering that how in 2 months can an auditor flesh out a report, okay, by going through, because that's the very time when bank audits are also happening. That's the very time when the individual ITRs are also being filed. And that's the time when we also come and say, okay, you need to give us a report. And maybe, it is going to create a kind of a bottleneck. What we feel. Apart from that, there are certain compliances in terms of maintaining records. Okay, one of that is, phone recordings. Okay, for all the advices being given, because now many advices are being given on email and they are being accepted on email, say approved on email. Now we don't have recordings for that. We are not very sure that, how to deal with this kind of requirement in the consultation paper.
Hello.
Yeah. So these are few things which are primary concern for us. Also, maybe, on the qualification and the experience part, I think very important to understand is that when you are working as an investment advisor, what matters is the skill set. People come to you because you have a certain skill set. And they doesn't necessarily come to you because you have a great qualification. Neither they come to you because you have passed any 10B exam in your first attempt. They come to you for a skill set. And with experiences made nil, that's the part from where your skill sets are coming to work as an investment advisor. Okay. So the concern is that if experience is moved to zero, then what kind of skill sets will enter into the industry? Because again, you don't want many advisors who may not be quality advisors. You have found the point. So it will have a reverse issue of more supply, but the demand is not sure whether to consume the supply or not. Because then you don't have quality advisors around. And anyone and everybody is trying to say that I'm an investment advisor. And if they are not able to differentiate between the two, it might create an issue.
So from that point of view, do you think the educational requirements should be completely done away with?
Which is okay, I feel, because see, it is good to have, not a must have. Because it doesn't necessarily, or there is no direct correlation between an education versus how and what you advise. It also depends on when you were educated. If I was educated 25 years back, it doesn't really work today, right? Because this was 25 years back, I did my post-graduation, whatever. Okay, very good, but it doesn't matter. So what did I do in the 25 years is important, because that's where my experience came from. That's where I acquired my skill sets.
Correct.
Yeah. But if that is missed, and suddenly I go and do a 10A10B and I pass in my first attempt, the real question to ask is that, does it substitute the skills what are required? And if you ask me personally, my answer is no. Because skills is something you only acquire when you work somewhere, you are experienced. It's a question of what kind of experience you have gathered. Okay. So that's a separate matter altogether, because is it an HR experience or is it whatever? I mean, it is an engineering firm experience. That experience is different, but there are certain skill sets which you would have acquired by working. Definitely. Okay. Then you give your 10A, 10B exam and prove that you understand the technical part of it. Okay. But completely doing away with experience is something, in my view, is might invite a new set of issues.
Okay. So it might have both its pros and cons.
Both has pros and cons, and it is very important to balance it properly. And numbers shouldn't be the only motivation. The quality of those numbers are very, very critical. And as an industry, we are also very mindful about it, is that the industry has to grow with the quality advisors. And the fun is in that, right? Because then we are competing with each other on quality. We are not competing on each other based on price. You are giving the best to an investor, and the investor is asking more, and you are trying to meet the expectation, and you are raising the bar.
Yeah.
And that is very important, and that will only come if you have, of course, good qualification, good experience, and you pass a 10A, 10B. All the three ingredients are important. So qualification is still good to have, not a must-have. Experience, in my view, is a must-have, not good to have. And 10A, 10B is a must-have. There is no doubt about it. It's a fantastic exam to give once. It's a very good syllabus, very comprehensive. Okay. However, repetitive exams, anyway, they have removed it, which is a good part. I think I missed saying this in the third part, where certifications remain, but only for first timers and not for people who are in the industry. So I think it's a huge welcome in that sense.
So hypothetically, if you were the regulator, would this be the way you balance when we look at solely the educational requirement that we were currently talking about, when you said that there needs to be a good balance for the pros and cons to exist and for this to function better, would you have kept the 10A, 10B as the must-haves, experience as the must-have, and the educational requirement as a good to have but not a must to have?
So I would have done one more thing, if I was the regulator. They would have said that, okay, it is, see, you can always apply. Nobody stops you from applying. So it is qualification good to have. Experience must have. Please specify what kind of experience you have, and please give some evidences for that. Okay. Certification, very important when you are applying. However, it is not necessary that we will give you a license. We will evaluate. It is a subjective exercise. We will evaluate whether you are going to do a decent job for an investor out there. And we are then going to give you a license. Just because these three criteria are met doesn't necessarily mean that I'm going to give you a license. That's a very good way to also control the supply side, more on the quality side. Because when I also have looked into the US regulations, One of the things US SEC has done is that the control of giving a license is still with them. Having the other criteria, the control of giving a license is still with them, which means somebody is thinking behind and saying that it is not 1 or 0. I'm going to decide whether I'm going to give this license to this person or not. There is a subjectivity involved. It has its own pros and cons, but it's okay because the regulator will do far better work when they look at more from a point of view when the papers come in front of them. They can decide whether this particular IA will do a good job or not. And they will not give a reason for refusing the license also, just like you do for a US visa, right? They don't give you a reason why they have not given you a US visa. You can apply. Whether you will get it or not depends. So regulator is not answerable to saying that why did I not give you a license? I would rather control it from that end rather than leaving it just like 1 or 0, like codify it, saying that if 3 are that fine, you get a license. Because I don't know what kind of people will enter the industry.
So basically, it's a shift from just ticking off the check boxes that they currently have to actually bringing in the human touch, the human logic, the subjectivity, and the qualitative checks of the person as well, right?
Very important, because I think regulator has always done a great job till now. I think even after 2013, I feel very confident when we are regulated. Okay, they have done a fantastic job. There is no doubt about it. Without being regulated, I think our posture would have been very different. Okay, we are now confident, we know what we are doing, and we definitely know that we are doing great work for an investor being regulated. Investors are also happy because you are on the right side of the table. You are being regulated, you are fiduciary. There is no doubt about it. And therefore, I feel that regulators should always have that, because they always have an investor interest in mind. They don't have anything else in mind, right? And I think that's a great job they have been doing. Globally, they are recognized today. SEBI is recognized today globally for what they have done. And therefore, I'm very sure that they will do a responsible job. There is no doubt about it. But if it is made 1 or 0, okay, I think that might be too much, because you're loosening it too fast, too soon, without knowing the implication of it. Again, going forward to 2030, you don't want this to be revisited again. Okay, that is my concern. So if I am a regulator, I would definitely have looked into this aspect and not given a free hand to the market.
Another point I wanted to discuss is that if I'm not wrong, this is the first time that SEBI is saying an RIA can be an RA as well. What's your sense of this suggestion? Will it lead to any unintended consequences of the misaligned incentives?
The consultation paper, if I read it correctly, it is basically saying that an IA can also take an RA license and an RA can also take an I license. Having said that, with segregation, with both different, meaning complete segregated activities, right? Which means you cannot mingle with each other. You cannot mingle those activities with each other. It has to be completely separate activities. Okay, which I think is fair enough, because earlier the problem was that an RA, correct, was earlier, if I'm not mistaken, or whatever I have heard, they refused giving an I license, and I was refused to be given an RA license. Okay, just because they have taken one license. This is what I have understood. I may be completely wrong. What I have understood from the market, and therefore I think it's a very good move which the regulator has done, more from an ease of business point of view. Is that if you are qualified, if the raw material and ingredient is the same, it is just in one activity, it is 1-to-1. And in the other activity, it is 1-to-many. And if you have the skill sets, and if you wish to do both, having clear segregation of it, why not? Okay, but time will tell again. See, there will be some issues, some things which we will surface, which we were not able to envisage today. Okay, but I think the regulator is strong enough to take certain bold calls later if they feel that this is not going the way they thought. I think today what they have done is more of first principle, saying that why not? Why can't they take it? Why should they be prevented? Which I think is a very good posture from a regulator. Second, why not? Until and unless the market proves the otherwise, second, hey, these are wrong things which we do, and these have been surfaced, and this, of course, these are both these entities will be audited. Okay, therefore, I think the regulator will do a fair job in my view.
Also, stepping back a little here, this entire structure of relying both the distribution and advisory with the Chinese wall, do you think that still distorts the incentives? Should investors be the only investors? Sorry, should advisors be the only advisors?
So, see, what has happened is that in 2020, one of the changes which the regulation did, which was not earlier, which was the client cannot be in both the divisions as a client. Okay, you can be a client under advisory or you can be a client under distribution. Bhavya, in your case, you can be an advisory client or you can be a distribution client. If I have two divisions. Okay, but you cannot be both. Okay, which is good, because if you want to be a distribution client for some reason, so be it. Again, it is ease of business. Ultimately, what an investor wants and how an investor wants to compensate, fully knowing the conflicts, fully knowing that there are no conflicts in the producer in the IA role. It's a fiduciary role where you have to cut a check and give a fee. Okay. Whereas here it's a limited advice or a restricted advice or incidental advice, because you only have that much requirement. And therefore you say, okay, I don't want to get into IA. I want to get into distribution. Then let the mutual funds pay your entity for whatever advice you have been given. I'm happy with your advice with that incidental piece and limitation. And it's okay. So as long as you are empowered, Bhavya, okay, it is good, because at any given point of time, you should not be disempowered.
Got it. So before we actually wrap this up, if I have to ask you that what all the goods and the not so goods about this consultation paper that we discussed, if there were any other changes apart from the educational requirements that we discussed in depth, what would that be according to you?
So my suggestion would be definitely to relook at this scope of activities being contained, because this may not help in the long run. This will create, issues in terms of ease of business. It will also create issues for the clients who are willing to avail the service. It becomes a very natural and an organic part of the advisory. Okay, you don't run an estate planning firm where the only job is estate planning, or we don't run a tax advisory firm where only work is tax planning. If you even look at the financial planning definition, the financial planning definition includes all these subsets. Okay, and therefore it is very natural for anybody to say that, hey, if you have advised to me on my asset, okay, and my liabilities and my income and my expenses and on my goals and on my behavior and on my risk profile, can you please tell me, or can you please help me on putting my will in place? Okay, or can you just advise me on this part of the tax part where, I will require this? Or I have some ESOPs of my employer. What should I do? Should I keep or not keep that? And if I wish to buy something else out there, what can I buy? Right? These are very, very incidental and organically so close that you cannot really look at it very distinctly and differentiate between them. Okay. Unless you are going saying that we are an estate planning firm and in that we do financial planning. It is not that. We do financial planning and estate planning is just a small subset of it. And the client is saying that, hey, I don't want to go anywhere because you are private to all my data. Then you just put a will in place. So we say, yeah, we can put a will in place. However, this will be the charges for the will. And the client says, fine, I'm ready to pay the charges to you. Right? So wouldn't it be better Okay, from a client's perspective, also that a will is put in place by the advisor who is advised on the entire asset, liability, income, expense, etc. And I think the job which we will do is far more responsible in that sense. Okay, there are no enforcement orders, by the way, again. Okay, which are basically highlighting any of these activities where there has been objections. Okay, I think at this point of time, the only thing I would wish the regulator relooks at it. Okay, and with whatever disclaimers, because we are mindful about it. And we don't want clients to go to SEBI and complain on this part at least. That, however, there are no evidences about it. But if at all it happens that estate planning was not properly done, and therefore we need to complain. Okay. There are already consumer courts which are available where you can go and claim your compensation on the contract which you have entered, right? SEBI need not really be dragged into this entire. And we have a regulatory system that way, right? I mean, the consumer court is there very much today, which is also passing orders for compensation in favor of people who, claim or whatever. So therefore, I feel that it will be too premature at this stage to come with something where your scope of activity is being curtailed. The consultation paper is great on many respects. Okay. However, this is one place where I feel that, if this can be seen in a different light, because we don't want to increase the burden of the entities. Correct? We want to do a responsible job. We don't want the client to go to different sets of people for different activities. It is just a very frustrating thing because you are so comfortable now to work and get an advice from us, and you have the comfort of giving your entire data to us. Now you have to go through a discomfort of giving this entire data to somebody else to prepare it. I think if the regulator relooks at this, it will be really good. Typically, the second part will be in terms of the operational compliances, which can be much more practical in nature, where the suppliers have to be there, right? The auditors have to be there. If the auditors is not there, how can we give an audit report? I think the practicalities needs to be understood. The way the country works today, our country works with the financial year ending 31st March. In 2 months, you know what happens with the audit forms. It's very difficult. You can imagine if it is 31st of December, just like international way of closing books, and we are told to close books by June of 30th, it is okay. But in 2 months, it is, in my view, it is too much to ask. And there are other parts where, call recording, etc., which maybe needs to be relooked as well.
Got it. So some changes in the scope and in the audits, in the record keeping, as well as the educational requirements that we discussed in detail before. Got it. Understood. Thank you so much for explaining all these. It was a really insightful session understanding how the regulations have actually evolved from 2003, actually, from when the regulations actually came into place in 2013 till now. So it was really interesting understanding the entire landscape over these last 2 decades, right? And to understand the nitty-gritties of the consultation paper that came this month. It was really insightful for me. I'm sure it will be for everyone who listens to this conversation as well. And once again, thank you so much for being on The Big Perspective, which is presented by Markets 5.0, Vivek.
Thank you.
Thank you so much.
Thank you.
And that is all for this episode. I hope you're able to take away some insights from this interesting conversation that makes you feel a bit more smart. And stay tuned for such insightful big picture perspectives every week.